What's up, everybody? Rob Gill, Epic Insurance Services, all things Epic. We want to talk about cash flow analysis and the importance of understanding what that looks like. And the question becomes, how much money on a monthly basis should I save for retirement? I'm here with one of my partners, David Harter. What's up, Dave? How you doing?
Great. Couldn't be better, Rob. How
Yeah,
are you?
thank you for being here today.
Thank you.
And some of the things that we like to talk about, obviously, when it comes to cash flow analysis and when you're saving money on a monthly basis, what does that look like for retirement? If somebody had earned income, right, and there's usually rules of thumb and they teach us these things, what would you say that they need to save on a monthly basis from a standpoint of paying themselves first? The PYF, pay yourself first, percentage of whatever their paycheck is.
We usually try to earmark 20%, Rob.
Can you explain a little bit more into that?
Sure. So the United States savings rate in households is really, really low right now. It's anywhere between 2 and 3%. And the reason for that is because Americans aren't taught how to save. So one of the first things that we identify is the importance of paying yourself first. And that comes with an earmark number where we try to get anywhere between 15 to 20% of your gross income paid to you first.
Yeah, and now, how many people do that?
Not many, Rob. That's the savings rate in the U.S. is so low.
And what happens when you first introduce that to people?
Well, it's a foreign concept to them, right?
Yeah.
They're kind of on the defense with that because they've fallen into bad habits. They've never done anything like that before.
Yeah.
So when we show them that the value of paying themselves first and the impact that's going to have for future retirement income, et cetera, it's usually very well received.
So when it comes to like cash flow analysis, right?
Yeah.
How do you look at that? Like how do you share with somebody? And feel free to go slow. I want all these good folks to understand cash flow analysis, money in versus money out. And then like a bucket that has holes in it, how do you patch up those holes? Take money that's going in a way that might not be for their best interest and redirect it for something better.
Absolutely. So if you bring your car into a mechanic, the first thing that they do is they open up the hood to see what's happening inside there. And so for us, if we want to take a look at cash flow, the first thing that we have to understand, Rob, is what's happening underneath the hood. The money coming in relative to the money going out. The average American household wastes a lot of money during the life cycle of that household. So what we want to identify is where that money's going. A lot of times families are spending without intending to send cash flow to places where they shouldn't be going. And by doing that analysis, sometimes we're able to capture that back.
Can you give an example of money being spent poorly?
Absolutely. Auto insurance. It's an easy example. So you don't typically look at your auto insurance policy on a yearly basis. A lot of times that's just a set and forget. And so as a result, we call that an economic junk drawer, where that policy went into the junk drawer and you didn't really think about it again. Most agents are not necessarily proactive to call and remind you that you need to take a look at that policy every year.
You said most agents,
Correct.
Right? So why don't you tell all these good folks why, so they understand what makes you a little bit different than everybody else?
What we do here at Epic Insurance Services is on an annual, semi-annual, or quarterly basis, we're taking a look at your policies. We're taking a look at the things you have in force to identify, are your deductibles appropriate? Are the premiums that you're paying appropriate? Is the carrier appropriate? Because a lot of times when you set something and forget it, you continue to pay more than you necessarily need to, or your deductibles are not in line with where they should be, and that costs people money.
And you and your team, is it safe to say that you guys really understand the importance of diversification, not only within and amongst asset classes, right? Put that to the side, but diversifying savings accounts or saving strategies. Can you expound on that a little bit?
Absolutely. So, obviously right now in the United States, interest rates are incredibly low. And so, when we talk about risk in any type of asset class, you also have a risk of earning too little, right? And keeping money by being defensive in a savings account only, where interest rates are incredibly low right now, Rob. I mean, in some places they're just non-interest bearing at all. Well, the lost opportunity cost of that lost savings and that lost interest is exponential. It really can't be calculated, Rob.
So what do you do?
So what we take a look at is alternative methods, alternative strategies for how that money that is earmarked to be liquid or is earmarked for future retirement cash flow, et cetera, is going to provide you the best leverage, is going to provide you the best yield, also while keeping in a safe and protected environment.
Question, is it safe to say the financial institutions have certain marketing strategies to push their products?
Absolutely.
For example, hey, save money into this 529 plan for college. When it comes to college education, is there other strategies that aren't as much marketed but could be better for people on how to maximize each and every one of their dollars to get the best use out of it.
Absolutely. College planning is like retirement planning on steroids. And so a lot of people focus in on what's traditionally marketed to them. And one of those programs is 529. And there are some merits to that, but there's also some downsides to that. As an example, is it includable when people apply for for financial aid? Well, the answer is yes, it is. So while I've been saving money for retirement, could that ultimately work against my family and hurt my family when I'm trying to get additional aid to go to school? Yes. So what we take a look at from a broad scope standpoint is, are there other strategies that are available that are either not included in that calculation or could be used after they go to school to help to pay off things like student loans, which is a huge problem in the United States.
Dave, thank you so much for sharing a tremendous job. And I want to just let all the folks out there know that we are pushing content every single day to give you an education and serve anything that you may have. Please, in the comments below, if you have any questions, specific or comments, if you do give us a specific question, we'll answer it and we'll shoot a video on it.